Hello. This is about taxes and kind of about reclaiming some of your interest payments. So, one of your benefits that you should look into is whole life insurance, not term life, whole life. This is stuff that is expensive as hell and pays out pretty much just what you paid in. Why am I telling you to get something that's not going to help anyone get rich? Because it will help you get rich. While you are still alive. Life insurance, not death insurance. Now, how this works is you are going to look for dividend yield or dividend paying whole life insurance. Now, the reason why it doesn't pay out these massive multiples, whatever you pay in, is because the odds of death is 100% because it lasts your whole life. Okay. When you're talking about these, some of these are on average between 9 and 12% interest. Not bad. Not bad. And because it's life insurance, if you pay into it, it's tax deferred. So no taxes going in. And unlike an IRA, where you're only able to borrow 50% of its value, these life insurance policies allow you to borrow 80% of their value, and the rate of repayment, the interest rate, and the schedule are far more flexible. We're talking over decades if you want. Anyways, yes. One of the stipulations is you do not fund this fully earlier than 7 years. I recommend no sooner than 7.5 to 8 years. I probably prefer 8 years because of politics in the 80s. Now, if you pay it off early, you create something called a modified endowment contract, and they will tax you up the wazoo and out the Obamacare. So, once you get this set up, and if you're like most poor middle-class people or people who've been screwed over, you get money in spurts, all right? And you can't just shove this money in these policies. So for this, I would recommend setting up some kind of trust fund, separate bank account, anything that makes automatic payments into this policy. Anything so that you can't spend it and it does not get paid off early. Next, contract. All right, we're gonna let's talk about paid up additions or PUAs. Yeah, I know, but if you have a $20,000 policy because you're like me and you started off broke as hell and you could only afford $200 a month because that is what the plasma center would pay you. Yeah, Michigan sucked. Anyways, where was I going? Then you occasionally get a random check from the government. Well, you could then just go and put that into the policy using a PUA. Yeah, it took me a while to get past the giggle factor on that one myself. And so what this is that you could just simply add $2,000, $3,000, $5,000, $15,000 in paid up, prepaid additional coverage on your policy. This is a quick way to go and shove some cash somewhere. Now, some of you are probably going and looking at me going, is this legal? And yes, it is. The tax code that this falls under is 7702. A comment made elsewhere was someone talking about trying to get around funding government legally through taxes and worrying about things involving the IRS. So I will, just like with the 1031 exchange, and that's a tax category, 1031, I will try to remember in the future to add that. But yeah, the tax code for this is 7702. I hope that one helps there. So anyways, how this works is you put the money in without any taxes. Then you borrow 80%, which is more than you would be able to keep in the first place. But then you can then go and write off the interest rate that you charge yourself on your future taxes, because that's a business expense, because the company owns the policy because they're the ones paying into it. If you need the money personally, you request a loan from the company, and then you write yourself a corporate loan to the person, or yourself, the individual. That way you avoid piercing the corporate veil, and you maintain those LLC protections. Don't we love that little trick? I love that corporate veil. Just, you have to remember, don't ever even try to poke that damn thing. Now, why would you do this? Well, 35% of your lifetime earnings are lost in overall interest payments. That's why. And if you buy a car using cash, you're going, yay, I'm not getting a loan, I'm not paying interest. Well, you kind of are. Because what you are paying is the lost interest your money could have been earning. By doing this, you keep the cash in the policy, and it maintains its rate of earning potential while being able to spend it. Now, I do not recommend spending it on a damn TV or a car. If you're going to spend the money, all loans, all debts should be used for the acquisition of assets. And how do you define an asset versus a liability? An asset puts money in your pocket. A liability takes money out of it. That even includes buying a Gatorade. Next. So, when you're doing this, remember, keep adding to your asset classes. Expand on your asset classes. And like, if you say I have 12 different stocks, I'm diversified. No, you're not. That's one asset class. Come on, man. Oh, if I say that, I'll probably get sued. But anyways, so think about that. Remember, this goes by a number of different names. This is private family banking, infinite banking concept, and cash flow banking. I'd say the godfather of this process is a man by the name Nelson Nash. He has a book on this called Becoming Your Own Banker. Yes, I own it. Full disclosure on that one. One of the more powerful aspects of this tool is you can borrow 80%. You can borrow 80% of cash that is losing value and put it into hard assets. You can put it in assets that will appreciate through capital gains. You can put in assets that will appreciate through cash flow. You can, once you cross a certain threshold, and for every person, that threshold is different. For one stage in my life, that threshold was $5,000. The next stage was $15,000. And then it was 26. Then a month later, most obstacles disappeared. Good luck. I wish you well in your hunting. Go forth, seek, and retain knowledge.